Mega Heaven PhD was established in 2024 and originated as experience of seasoned professionals in the accommodations, tourism, technology, and finance sectors. The owners wanted to establish a brand that was connected to sustainability, innovations, and quality. The company may serve a wide spectrum of customers, from luxury vacationers to tourists on a tight budget by building up a varied portfolio of properties in rarely land that be bought in 6 years ago before the company created. In order to improve visitor experience, the corporation has made large investment in environmentally friendly projects like renewable energy sources of land and energy efficient building designs. They also provide high service standards, are maintained throughout all of the company's properties by placing a heavy emphasis on employee training and customer-centric ideals. They also creating new brands with the help of a strong financial base and a prosperous foundations. Next, the career recognition for Mega Heaven Berhad is firstly missionary. Mega Heaven Berhad is starting a large-scale sustainability strategy for its luxurious resort properties. The company intends to invest a significant amount of money in eco-friendly and low-carbon machinery as part of this business. Next criteria is buildings. Mega Heaven Berhad is also launching an experimental plan for growth to build an innovative luxury hotel on the island of Pangkor. The hotel's objective is to deliver an outstanding visitor experience. For journals entries, first part for the initial cost in total for capitalized machinery is 520,000 ringgit Malaysia, and for the building, the total initial cost for capitalized is 14,500,000 ringgit Malaysia. For expense of also is 2,500,000 ringgit Malaysia.
My name is Aisha Akina Mindiana, MBA 2207064. So, for the initial measurement on machine, on 1st January 2015, Mega Heaven Berhad placed an order for a machine from a company from Japan. The machinery is delivered on 31st January 2015, and the invoice price is RM500,000 with a cash discount 5% if paid within 30 days. Import duties and taxes amounted to 30,000, and it also incurred transportation costs and installation costs. So the initial cost for the machine is RM520,000. Next, the company also acquired building which include contracted costs, direct material costs, direct labor costs, and engineering and technical overhead. So the total initial cost for the building is RM 40,500,000 will be capitalized. Other than that, the company also complete the installation in telecommunication network facilities. The cost incurred is site preparation, equipment, delivery costs, commission, installation and assembly, professional fees, and the present value of cost decommissioning, which the total cost for the building is RM 848,250 will be capitalized. For the subsequent measurement cost model, the machine cost is 520,000 with 10 years useful life. On the 1st January 2019, major component costing 150,000 ringgit was replaced with new component costing 300,000 ringgit. Carrying value for 2018 minus carrying value for old machine plus cost of new component will get the new carrying amount. The 31st December 2018, the accumulated depreciation is recognized for the 4 years from 2015, which is RM 208,000. On 31st December 2019, the accumulated depreciation is RM 87,000. So the carrying value of the machine is RM 435,000. For the revaluation model on 1st January 2015, Mega Heaven Berhad acquired machine initially as purchase price at 520,000. On 31st December 2019, depreciation was recognized. RM 133,333 in profit or loss, and revaluation deficit will be charged for RM 60,667. Moreover, Mega Heaven Berhad acquired building cost RM 50,500,000 with 10 years useful life. On 1st January 2012, there was a huge flood in Malacca, and the administration building were major part of the building. RM 550,000 were damaged, and it was replaced with new part costing RM 800,000. Carrying value for 2012 minus carrying value for old machine plus cost of new component will get the new carrying amount. The accumulated depreciation for the year 2019 is 32,800,000 divided by 8 years. So the amount is RM 4,100,000. The carrying value on 31st December 2019 is 28,700,000. So for the revaluation model on 1st January 2011, Mega Heaven Berhad acquired building initially as purchase price at 40,500,000. On 31st December 2015, depreciation was recognized for RM 3,333,333 in profit or loss, and revaluation surplus of RM 23,333 million will be credited to Sopwith.
Next, accounting treatment. Firstly, missions. On 1st January 2015, Mega Heaven Berhad acquired missions initially as purchase price at 520,000 ringgit Malaysia. On 31st December 2019, depreciation was recognized 800,000 ringgit Malaysia divided with 6 years equals to 113,333 ringgit Malaysia in profit or loss, and revaluation deficit will be charged for 16,667 ringgit Malaysia. Secondly, is building. On 1st January 2011, Mega Heaven Berhad acquired building initially as purchase price at 40,500,000 ringgit Malaysia. On 31 December 2015, depreciation was recognized 20 million ringgit Malaysia divided with 6 years and equally 3,333,313 ringgit Malaysia in profit or loss, and revaluation surplus of 23,313,313 ringgit Malaysia will be credited.
Introduction of the company, Ecoworld Development Group Berhad was established in 1974 in Kuala Lumpur. It's a Malaysian investment holding company with a gross development value over 80 billion. The company develops over 8,000 acres of land bank in Penang, Iskandar Malaysia and Klang Valley, serving various real estate market segments. The investment properties are buildings and land for long-term capital acquisition. This investment property will give future economic benefits such as rental income, and the cost can be measured reliably.
For initial cost, the first method we use is self-constructed of building. We need to minus the inefficiency. So for the direct material 6 million, we need to minus with inefficiency 2 million. For the direct labor 4 million, we need to minus with inefficiency of 1 million. To calculate the cost of building, firstly the contracted cost add with direct material after minus with inefficiency, we get 4 million, and then to add with direct labor after minus with inefficiency, we got 3 million. Then we add with engineering and technical overhead. Then we sum up the amount and we will get the cost of building of 77 million. Second method of initial measurement is purchase land by cash. So firstly, purchase price is 3 million and then we need to minus with cash discount. To get the cash discount, 5% we need to times with purchase price and then we get 150,000. And then we minus purchase price with cash discount, we will get net invoice 2,850,000. Then we add with property tax 6% times with the net invoice, we will get 171,000. And then we add on with legal fee of 500,000. Then the total cost of land we will get is 3,521,000. Next, for the subsequent measurement of building, cost of initial measurement is 77 million. During 2015, we get fair value gain of 9 million. During 2016, we get fair value loss of 5,500,000. During 2017, we get fair value gain of 9,500,000. During 2018, we get fair value gain of 500,000. During 2019, we get fair value loss of 20,500,000. And during 2020, we get fair value gain of 500,000. So during 2021, we transfer the IP to PPE. So the dean cost is 17,500,000. We minus with depreciation of 70,625,000. Then we get carrying value of 52,008,750.
For the accounting treatment of MFRS 140, firstly, the property is reclassified from IP to PPE on 1 Jan 2021. The initial cost of PPE is measured at fair value of IP of 70.5 million as at date of transfer on 1 Jan 2021. The changes in fair value of 500k, which is 70.5 million minus with 70 million, is charged to profit or loss as fair value loss. And the depreciation of 17.625 million is charged as an expense in profit or loss. Next, we move to the journal entry of MFRS 140. On 31st December 2015, we debit the investment property and we credit the SOPOL, which is fair value gain, with the total of 9 million. Next, we debit the bank and we credit the SOPOL, which is rental income, with the total of 600,000. This entry will be recorded from 2015 until 2021. On 31st December 2016, we debit the SOPOL, which is a fair value loss, and we credit the investment property with the total of 5.5 million. And on the 31st December 2017, we debit the investment property and we credit the SOPOL, which is fair value gain, with the total of 9.5 million. Next, on the 31st December 2018, we debit the investment property and we credit the SOPOL, which is fair value gain, with the total of 500,000. On 31st December 2019, we debit the SOPOL, which is fair value loss, and we credit the investment property with the total of 20.5 million. Next, on 31st December 2020, we debit the investment property and we credit the SOPOL, which is fair value gain, with the total of 500,000. Next, on 31st December 2021, we debit the PPE and we credit the investment property with the total of 70.5 million. And lastly, we debit the depreciation and we credit the accumulated depreciation of PPE with the total of 70,625,000. That's all from me. Thank you.